Okay, welcome everyone. We'll start this discussion. As you know me, my name is Sarkar. If you have any question, please drop me email. Management-LO5. I'll try my best to get back to you as soon as possible. Today lesson we'll discuss about be able to critically appraise investment options. So our key assessment criteria: assess, reflect, and justify. Managing working capital and appraisal of investment options, capital revenue, expenditure, risk, cost control, cash flow, time value of money, different method of project appraisal like accounting rate of return, payback, discounted cash flows, present value, allowances, inflation, all will be in our discussion. Okay, so lesson 1, we discuss about costing system, cost method, ABC, absorption, marginal, process costing, cost center, direct, indirect cost. Lesson 2, we discuss about financial statement and ratios. We discuss 4 types of ratio: liquidity, profitability, use of resources, and gearing ratio. And lesson 3, we discuss different types of budget, and we said, to make budget, sale forecast is the first crucial thing. And lesson 4, we discuss about short-term, long-term, and medium-term sources of finance. Okay, so always good to be look around what is meant by appraisal and current year knowledge, and always good to be reflect, what you know already about investment appraisal. So appraisal mean measuring the performance. So performance in terms of cost, quality. In an organization, it's good to use 360-degree appraisal. Not only senior will do the appraisal, it's your colleague, subordinate, all give the views, and that's all the point base. And then you can give appraise. But here we're looking at the financial appraisal methods, net present value. If the NPV, net present value, time value of money, the pound today is more worth it, the pound you will get in future. So positive NPV, we accept the project. Negative NPV, we reject the project. IRR is the internal rate of return. So that's, which we need two NPVs. We need one positive, one negative, and in between is IRR, internal rate of return. So ARR, higher is the better. As the Bank of England basic interest rate increase, so we need to be look around, what return you have, is it match with it or not. Risk, higher the beta, higher the return we normally use in business, higher the risk. Any question, please? So first we'll go through 5.1 appraisal methods in line comparing investment project, different kinds of organization. The most common objective of investment appraisal to maximize the shareholder wealth, and this is because the decision made by the company where the director have a duty to act in the interest of the shareholders. Research has found to develop the decision-making metrics and maximizing the shareholder value, the following factors need to be incorporated. Cash is the preferable to profit because the cash is most important. Cash is the lifeblood for any business. Exceeding the cost of capital. What cost you if you borrow money? Yes, so it should be, the return should be higher than the cost. Of course, we want to be more than break even. Must be sufficient to cover the cost, debt, and exceeding the interest payment, but also the cost. So always look around the opportunity cost as well. Greater than the cost of capital and upgrade the loss, and never mind is pay taxes had the genuine profit. That's the key we need to be, and more we want to be. Because the sales can be credit sales, it's not generate the cash. Here we're looking at the time value of money. Okay, managing the long-term and short-term prospective shares in the stock marketplace as the value on the company's future potential and not just, its current profit. The company's announcement about the capital expenditure, research and development, new investment are often treated as a positive rather than the negative factor market. And even though these announcements may have a detrimental effect on the short-term profit, and biotechnological companies, for example, clearly have a value despite the fact many currently have no product. So time value of money, like earlier I said, if you have £100 today, the £100 will be, if you get in a few years time, that will be £100 today is more worth it, the £100 you get, because the value of money with the passage of time is depreciates its value. So you have to look around the return you have is more than that. So cost of finance, if we loaned and the money received, the sooner could you use to repay the interest and the payments made, might be increased the loan overdraft and resulting. Inflation also impact, on the value of money. Risk future cash flows are less certain. Maybe you get you don't get, like COVID-19 happened, and interest rate war uncertainties. That's the factor we need to be always keep in mind. Implication can be very significant, particularly for the long-term project. The time value of money is reflected in the techniques such as NPV, IAR. Okay, so investment appraisal is a business concept which compares the expected future income to be derived from the investment with expenditure of incurring investment and non-profit. Thus, we need to be look around, and investment appraisal is used to look around the potential capital investment by firm and measure the potential value of firm. There is more than one method of appraisal. Each different method allow you potential return, investment, and explain you different ways. That's which we look up. Okay, let's say you want to make or buy a decision. If you want to do, either you make yourself or you buy. Yes, so internally are contracted out comparison of relevant cost, and look around direct effect of the company. Closure of the business segment unit is a closure of the business unit have temporary or the permanent, and will tend to be based on the short relevant cost for it, and non-current assets and redundancies cost. Both we need to be and look around what you have the benefit and time value of money. Discounted cash flow is the concept is mean if you want to be value, you have to decide what is the cost of capital. Like if you have the basic principle, discounted it we has to be the dollar at the pound in a year's time, and we need to be invest certain sum now and the interest rate percentage, and we can look around the compound interest or you getting state interest. Discount factor is shown the present value table provided in assessment. We're not doing the assessment, but we can look around. We're doing assignment as an assessment. You don't have example to do discounting. Terminology, time value of money, net present value, net terminal value, or net present cost of the life cycle cost. These are the concepts we'll carry on using. I mentioned earlier, £1 today is more worth in the £1 we will get in future. That in few years' time, that will be, we need to be really focused on this. Okay, so here is the example. So if you're looking to invest 100,000 and you getting end of year one, you're getting 20,000, 40,000, and 80,000. So what is the money if you're getting after 1 year? What is the real value? So always is good to be, you can find online as well, but you can use the formula 1 divided by 1 plus R. If I'll say the discount factor, you use 10%. So if I'll say 1 is in formula, 1 divided by R is the discount factor. So if I'll say 10%, it means 0.1. So you do 1 divided by 1.1. So your answer will come is 0.909. Whatever answer you have, if you carry on divided by 1.1, you'll carry on, you get to the £1 value will be dropped down to 82 pence, and the year 3, whatever answer you have, year 2 divided on 1.1, you will get 0. So this 10%, it can be 15, it can be 20, it can be 8, depends on your cost of capital. You have to use your judgment. You look if you're borrowing money, cost, what return you expect, you discount it, what is the real value of the money is. So you're investing, if you're getting 20,000, actually the value of 20,000, 10% depreciation would be 18,180 pounds instead of 20,000. Then if you're getting 40 after 2 years, it will be valued 33,040 pound. Yes, 33,003. So you have to look around. And then in year 3, if you're getting 80, actually you're not getting 80,000. The real value is 60,080 pounds. So what you do, add them all, inflows, the money you're getting, minus your outflow. If your inflows are higher than the outflow, so like we have an NPV, the positive, we accept the project. But if you're comparing two projects, A and B, so always look around the higher NPV ones. That's the key concept, NPV, net present value. If positive, accepted, if negative, rejected. Okay, then we'll go through payback period. Payback means how much money you invest, how much money you will get. Each method have appraisal, its own advantages and disadvantages. So always good to look around. Whichever method you use, you need to make sure you focus on. Okay, yes, let's look this slide. So payback is easy to calculate, easy to understand and consider timing of the cash flow, how quickly you can. Next slide, I will give you an example. Can ensure the short-term thinking rather than the long-term, because the payback or the break, even what you invest, what you get, maybe 2 years time you cover. But some project can give you benefit forever, like investing money in education, investment on knowledge. So that's we can think about in terms of Nokia, why Nokia declined, because they focus more on the cost. They closed many research and development centers throughout the world. Ultimately, what's happened, they not managed, so they boost it, but in the long run, it has huge impact. All these need to be considered. So if you go here, we are investing 3,100 pounds in year 0. Year 0 means current year, and then you cumulative column, you look, what you invest in 3,100, that money out, you're getting 1,000 pound back, which is inflow. Then remaining is 2,100. Year 2, you're getting 9, and after year 2 is 1,200 left. Year 3, you're getting 800, and 1,200 minus 800 is 400 left. So we showed this project will take 3 years and some months, because in the month 4, in the year 4, year 4, you're getting 500, which is more than 400. So we can't say this project will take you 3 years. This project will take you not exact 4 years. This project will, so outstanding amount of the following year divided by previous year divided by the following year inflow. So 400 divided by 500 times by 12. So for this project will takes us 3 years and 10 months to get what you invest. Anybody, any question? Okay, so this is here. So always shorter. If other project will give you only 3 years, so we'll say project A is a better if we give 3 years, and project B give you 3 years and 10 months. So we'll accept A instead of B. Okay, then we have NPV, take in account money at the time value. NPV look the future return, project today return, forecast the return are discounted and find the present value and investment. So this considered time value of money, considered both timing and the cash flows, and more difficult. So I will say time value of money sometimes are difficult to explain in a way. So we need to be the choice of discount rate. That's it can be arbitrary. So we need to be, it can be 5, it can be 10. Best you can estimate it. Like at the moment, inflation is 10%, base rate is 4.5 in UK. So your discount factor can be higher than 15%. Yes. So you can use it at the cost you have the capital. Okay, so let's, if we look here, this is we based on the 10% discount factor. If you're investing 20,000, so you're getting 5, 7, and 8. If you add them all, that give you 12 and 8. It's exact 20. So, but that 20 is not real value of 20. So you do what divided by 1 plus R. Formula you find online that we've been given in every book of financial management. It shows the discount factors are PV factors. So you look £1 in the year current year not, which is base year, and then it's depreciate 1 divided by 1 plus R, 1 divided by 1.1, and whatever answers you do, because it's 3 years. If you're getting 5,000 times by, and this means 5,000 value is 4,545, and you add them all these PV values and take out the base year what you invest in outflows, and that's so in this case we have NPV is negative, we reject the project, we not accept the project. Okay, then we have a next method is called ARR. Is called accounting rate of return. So how much is average return you have in a year? So what you need to play, always use the formula average profit divided by initial investment times by 100. So we can find, and some people do average investment as well. So nobody's just use this one. So please, we can look around next. Let's say we have 3 projects, which is you can say A, B, C project, hand over this M project. And these are the year not. We are investing current year 4 million, 5 million required for. So if you're getting 1 million in 5 years, you're getting 5 million. 5 minus 4 is 1 million in profit. 1 million in the profit. How many years? 5 years. So 1 divided by 5. So every year profit is 0.2 million every year. Doing the second project, 1.5. 2.5 and 0.5 million, 0.5, add them all, still 5 million minus is 1 million profit and still 0.2. Average profit divided by initial investment, which was your 4 million. So it's a 5% return as a percentage wise is K. In the project C, you have 5 million required, but you're not getting year 1, you're getting your return in year 2, year 3 onward. So you're getting 5 million you invested. So you're getting 0.5, 1.5, 2, 2, 4, and 3, 7 million you're getting, 5 million you invest. 7 minus 5 is 2 million your profit. 2 million came in how many years? 5 years. And it's 0.4 million every year. 0.4 divided by 5 times by 100, so it's 8% return. So if I look the percentage, the project C is better than project A and B. But if you don't have 5 million to invest, so what you can look around? You can look around option A and B, and you can go for B because both have a 5%, but B's give you higher return in the yes, cash is coming. So that's the best to use. Okay. I included some more activities. So displays based on discount factor. You can look around yourself, try to calculate before next lesson based on the example. So what you need to do, if you do 10% discount factor, which is cost of capital, so you do DF discount factor like we done here. Yes, so you do exactly for this example. So you do 1 divided by 1 plus R, and whatever answer discount factor you use, you calculate. Okay, so that's you've been given example. So please calculate these payback period now, and we'll look these in the next lesson if you try until next week. And then we compare, so 2 years, 5 years, 5 years. And we can look around if you invest 100,000, you're getting 120. So it's take 1 year and few months. So that's your, okay. So we need to be look around Yes, and calculate the payback period for these. And these are the investment appraisal example. Then we looking a plan to express in money is a prepared to provide the prior budget. We need to be make sure when we make the budget, we need to be look around what will be the real value of that, and the budgetary control is very important. So we need to be focused and included in the stuff here, please. And we'll find the variance. Variance is the difference between budgeted and actual. Always we focus, every organization requires three types of resources: men, power, money, and material. Yes, responsibility accounting, when you're giving the budget, you will appraise them accordingly, what is. So that's called responsibility accounting. Okay. Then 5.2, it justify the strategic investment decisions for using the relevant financial information. Business face many different types of decisions, ranging from strategic choice, such as should we enter into new market, tactical ones, such as should we make the product ourselves or we can outsource. So based on your investment appraisal, you can look at which option is best. Operational decision, now we recognize the production to maximize the profit. Yes, workforce us off sick this week. So what we do in solving such, decision involved in the mixture of quantitative and qualitative, the quantitative mean numbers and qualitative mean opinion, qualities and other consideration need to be not just the money. So many different techniques being developed and assist, decision making, which we can use like investment appraisal method. Long-term decision making is often involved use, discounting. Cash flow technique, short-term decision making, we can look around the marginal cost is contribution. Contribution always come from a selling price minus variable cost equal to contribution. That's which we're decision making with the limited of the scale resources. That's which we need to look around. Incorporated risk and uncertainty. Uncertainty means these things are not certain. They can be number of reasons. Higher the risk, higher the return, we said. And don't put all your egg in one basket. Maximizing shareholder wealth, the maximizing the common objective of the decision scenario. We need to be looking around what effect will be on the shares. Is current shareholder will issue new shares if we'll do the project, what will be the effect on the shares value? It will go up, if we're doing something contributing to the global warming, and ultimately this give us, the future sales and the reputation. That's maximizing the shareholder wealth. Yeah, decision making metrics we can look around. Cash is the profitable profit. Yes, cash flows are a higher correlation to the shareholder wealth maximization, not just you look, the profit itself. Exceeding the cost of capital return, however, the measure should be sufficient to cover the cost of debt. Exceeding the initial payment, and Peter Drucker comments Harvard Business School, the unit of business return of the profit is greater than the cost of its operate at a loss. Never mind that they pay the taxes, that it had the genuine profit and inter return and the company and economies, and then to the resources until it does not create the wealth. So as we said earlier, financial information is quite crucial. We need to be look around the objective of entity to maximize the shareholder wealth. We need financial information to make the financial information decision, and we need to be always, an operating system. We need to be develop the system. We need to be make sure that provide and report and provide, information. On the basis of this, we can. So every transaction we need to be, we can review and we can make the right decision. Okay, the flow of the information initial transaction in the statement, the date is received from the transaction and the event, and transaction event is recorded in the book of entry. And we summarize this is all accounting system is need to be crucial that provide the financial information need. Who need it? Different stakeholders need information for different purposes, and that's which we need to be. We need to make sure we'll carry on doing it, because otherwise, we'll struggle to. A manager needs both internal and external information to inform business decision and report externally the actual information providing management was depending different level of management. Yes, so operating managers, strategic managers, yes, those different. So different information system available to provide information. 5.3 critically analyze the strategic investment decision. So internal control and the risk management is a fundamental component of the corporate governance. Good corporate governance is broad, identify all the risk of the company and then relevant management to identify and manage risk. Risk is mean probability of happening something. Always look high the risk, high the return, and we look around on the Google Finance, different companies if you want to invest. So you have to make sure you make the interpretation of the financial statement on limited use. You have to look around some extra. So made profit 1 million. What does that tell you about the business? So just the business is succeed. It must not. The previous year they made 50 million profit. It's a revival and 60 million. So it is simple to use the financial statement, interpret and comparison previous year and forecast the competitors, and we can look around expense, liability balances and the cash flow performance analysis. Ratio analysis is widely used the process comparison as we discussed in lesson 2 and 3 we mentioned as well, and forecast, the ratio. We discuss about profitability ratio, liquidity ratios. And these are the ratios very useful to prepare and interpret the financial statements. User of financial statement, we interpret the financial statement important asset and we use the accounts and information, the shareholder, potential investor, concern, receiving adequate return, supply, they want to make sure that that is secure, or management want to be earn more profit and business succeed. Other potential user, financial institution, they want to be make sure their debt is secure. Imply they want salary, professional advisor, and investors, and journalists, they all need information. And then please, you've been given to test your understanding about investment appraisal. Appraisal mean, checking the return and the real value of the money. And that's, which we discuss. And we discuss about payback period, time value of money, which is NPV, and we discuss about ARR. These are the key investment appraisal methods. So please go through, and if you have any questions, make sure to drop me email and you can ukversity.co.uk. Thanks for attending, and also speak to you all during our next session. Thank you. Bye-bye.